Hello, welcome to Global Business Insights. This is Bode Oshosami on another episode where we discuss the latest issues, today focusing on market reactions to the return of Donald Trump amid monetary easing from apex banks in major economies. First, some data. Eurozone September annual retail sales up by 2.9% after rising by a revised 2.4% in August, also beating forecast of 1.3%. US markets were up by record high percentages as a cautious euphoria descended on sentiment amid what looks like a smooth political transition in the world's largest economy. A Republican clean sweep makes it significantly easier to implement full policy agenda. The Dow surged more than 3.6%, also the largest post-election day gain since November 1896. Gold prices fell by over 3% yesterday, partly due to dollar strength from Trump US-centric pro-tariff protectionism. Bitcoin also hit an all-time high following Trump's earlier remarks favoring the cryptocurrency. At the Bank of England monetary policy meeting ending yesterday, the MPC voted by a majority of 8-1 to reduce the bank rate for the second time this year by 0.25 percentage points to 4.75%. Interest rates could take longer to fall from now after the Bank of England warned that the latest budget could send inflation creeping up. We show excerpts of Andrew Bailey's comments on the impact of the recent autumn budget. And in the US today, the FOMC, that's the Federal Open Market Committee, announced its monetary policy decision just a day after the US election. The rate fell from 4.75% to 4.5%. Again, we will listen to a clip of Jerome Powell's views on how he sees the election shaping policy. A familiar pragmatism suggests parts of the Trump agenda will not be implemented, but US equities, at least in the short term, are well supported by decent economic and corporate earnings growth, political clarity, and Federal Reserve rate cuts. A deregulatory pro-growth agenda and increase in small business confidence is expected to more than offset the negative effects from potential tariffs and tighter immigration policies impact on employment, which could lead to an uptick in wage growth. Focuses on trade policy with higher tariffs and possibility of a trade war 2.0, and debts and deficits going up given higher tax cuts. The deregulation trade is a boost to the major banks. The financial sector is the big winner here by far. No surprises. Wells Fargo, Morgan Stanley, and Goldman Sachs were both up over 10%. Another winner is the oil and gas space, as regulatory reform opens up more activity in exploration and production. Musk will have a say in shaping a bid for US to be the leader globally in AI across all areas. That will include pushing for more energy and power build-out for data centers to enable strong growth and success for cloud artificial intelligence players. Cryptocurrency regulation will also lighten, with Bitcoin spiking to another record high. There is nervousness, though, on how Musk intends to cut $2 trillion of government fat. The Inflation Reduction Act will be tweaked to be less favorable to EVs, but a full repeal seems unlikely. Market watchers also see capital flowing more into India and Japan instead of China as investors assess Trump's anti-China stance. Europe and emerging economies can expect a tougher external front on trade and investment as more capital is attracted to a lower tax environment in the US. Africa needs a continental response, moving faster on African continental trade, the Act, amid a more protectionist Western economy looking to Africa selectively for opportunities. Global monetary easing progressed with two major economies, the United Kingdom and the United States, both deciding today to cut further by 25 basis points. The Bank of England Monetary Policy Committee added that the combined effects of the measures announced in the autumn budget are expected to boost CPI by just under 0.5% at the peak. The inflationary impact of the budget was perhaps the reason responsible for one member preferring to still hold rates. The pound sterling gained against its major peers as the rate decision was announced.
Chart 1, it's just come up, shows the evolution of 12-month consumer price inflation. That's the purple line over the past year. It's fallen a long way to an average of 2% over the past 5 months and 1.7% in the latest data, which were for September. This is 0.4 percentage points below our August projection, which is shown in orange, and around 1.5 percentage points below our projection from a year ago, which is the blue line. So the disinflationary process has progressed well, and indeed faster than we expected. Looking further ahead to the next 6 months, which is shown in the shaded area of chart 2 that's just come up, we expect consumer price inflation to rise somewhat as the drag from lower energy bills wanes, that's the orange bars, and the contribution of services price inflation comes to dominate, that's the yellow bars. It's encouraging that we can now move forward from a lower starting point. But services and price inflation remains elevated, and recent downside news has tended to be driven by more volatile components, such as airfares and accommodation. Our November projection is conditioned on government policies as announced in the autumn budget. Chart 4 shows public sector net borrowing and how it is projected to change relative to the previous March projection by the Office for Budget Responsibility. In the autumn budget, the path for public sector net borrowing is higher than it was in March, but the chart on the left also shows that the difference is more pronounced in the first than in the future years. Public sector net borrowing is still projected to fall significantly over the forecast period. We provisionally expect the measures announced in the budget to boost the level of GDP by around 0.75% at their peak in a year's time. This reflects the stronger and relatively front-loaded paths for government consumption and investment, more than offsetting the impact on growth of higher taxes. Overall, fiscal policy is still expected to tighten over the forecast. But all else equal, the changes announced in the budget are expected to reduce the margin of spare capacity in the economy over the forecast period. The marginal effects on our inflation projections from the autumn budget are shown in chart 5, which has just come up. Combined, measures push up on inflation by just under 0.5 percentage point at their peak. That's the white line. The extended freeze on fuel duty pushes down on inflation over the next fiscal year, that's the orange bars. But as it is assumed to rise thereafter in line with announced government policy, fuel duty then pushes up on inflation from the second quarter of 2026. Other measures directly push up on inflation over the first year, that's the purple bars. Now, there are different ways in which the increase in employer national insurance contributions could play out in the economy. It represents an increase in the cost of employment. There are at least 4 margins of adjustment. Firms could pass on higher costs to consumer prices, or firms could absorb the increase through lower margins or higher productivity. Firms could increase wages by less, or firms could respond by reducing employment. So at this meeting, the committee voted to reduce bank rate to 4.75%. Based on the evolving evidence, a gradual approach to removing policy restraint remains appropriate. Monetary policy will need to continue to remain restrictive for sufficiently long until the risks to inflation returning sustainably to the 2% target in the medium term have dissipated further. The committee continues to monitor closely the risks of inflation persistence and will decide the appropriate degree of monetary policy restrictiveness at each meeting.
The US Federal Open Markets Committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 4.5 to 4.75%. They will carefully assess incoming data, the evolving outlook, and the balance of risks, also strongly committed to supporting maximum employment as they seek to return inflation to its 2% objective. No mention of politics in the statement. Some have suggested that President Trump's return to the White House could refocus the Federal Reserve on fiscal stimulus and tariffs down the road, and so need to watch inflation, and that may imply a hawkish shift. But let's listen to the press statement on what Powell thinks on the impact of the developing politics.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 0.25 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can move more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. Let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Asia-Pacific equity markets were higher, helped by record rise to U.S. market shares overnight. Investors saw more fiscal stimulus measures as the closing 5-day meeting of China's National People's Congress notes the need for fresh steps to offset the impact of any tariffs as Trump returned to the White House. China's October export data showed a rapid acceleration, the fastest since July 2022. Exports jumped by 11.2% year-on-year in October versus 1.6% in September. Wall Street stocks continued to build on the huge market rally following the decisive victory of President-elect Donald Trump as traders digest the latest interest rate cut and any further clues on the trajectory from the Federal Reserve. Well, that's all we can take on this episode of Global Business Insights. Thank you so very much for sharing and watching.